Ivan Maltsev with you, a general partner from 3X Capital, and today we have a special guest, Robby Greenfield, co-founder and CEO of Umoja. Also, I know that Robby, you worked before with ConsenSys. It would be great to hear your introduction in the beginning.
Yeah, absolutely. Well, one, Ivan, really do appreciate the time. I'm glad to be with you and your team. So a very brief background on myself. I have over a decade of experience as a financial engineer. Started my career at Goldman Sachs and have been in crypto since 2011. And then, yes, to your point, was former head of social impact at ConsenSys. So I've developed and deployed dApps over a dozen times in over a dozen countries, usually in the context of emerging market payments, humanitarian aid, and self-sovereign identity. And also a tokenomics nerd, or at least I try to be as much as possible. So.
Great. Thank you, Robby. Can you please introduce what you are building right now?
Yeah, absolutely. So we're building the Umoja protocol, and very simply, it helps you eliminate crypto losses. It makes sense that this is debuted around this time because we just got out of a very long crypto winter, over $1.9 trillion lost, mainly by retail investors. And the main reason is because, outside of the appetite for gains, which we all have, it's really not a behavior to cover your losses. And most people who do are technical traders, right? They understand derivatives and how to trade them. But a lot of people don't have that experience. And so we wanted to create a protocol that enabled anyone to hedge market losses like a hedge fund in under 10 seconds.
Mm-hmm. Yeah, that's a great solution. I'm personally excited to use it on my own because I'm also doing a lot of portfolio management in DeFi specifically. I'm curious to know, how did you come up with this idea and with the name of the protocol?
Yeah, absolutely. So it was a long road to get to where we are today. So Umoja Labs originally spun out of ConsenSys, our ConsenSys social impact. The first 2 years, we focused on humanitarian aid, worked with Oxfam, Mercy Corps, Red Cross, et cetera. And we did about 1.5 million in revenue off of that business, but started to realize two things. One, working with NGOs, it's a longer term engagement, but two, a lot of our customers engage with a lot of different fiat currencies, right? They're in nearly every country on the planet, trying to help people. And so you encounter a lot of currency exposure. And as you know, some currencies you would like to hold, other currencies lose value very quickly. And so this FX hedging issue was a major problem. And it wasn't only until later that we realized that not only our customers were having this problem, but also our competitors were having this issue as well. And so we, started to think of, okay, how can we automate this? Because the way that people usually hedge any risk is they'll go to an institutional bank, they'll create a derivative strategy for that particular entity, and then they'll go from there. It usually takes 4 months. It's very expensive, has very high liquidity requirements. So the whole act of financial risk mitigation is really an institutional capability or a pro trader capability. And so we created a futures trading algorithm to hedge fiat currencies like the Mexican peso, Kenyan shilling. And we realized that, most of our experience is in crypto. And so we should be applying this not only in the context of crypto, but we should protocolize it. We should democratize it so that not only can we introduce our own hedging strategies, but in the future, others can introduce theirs. And we can all have hedge fund-like tools that require no technical knowledge whatsoever. And so that's a long story short in terms of how we got from humanitarian aid to hedging today.
Yeah, actually, wonderful story. I love it. Are you also investing in trading on your own?
Yes. I that was, as you know, it's baptism by fire in the crypto space. We all think that we're pro traders as soon as we get introduced. And so, the very first thing that I did in crypto in 2011 was start a day trading hedge fund at University of Michigan with other varsity athletes at that time. We came up, 20x, but of course it's easy to say that when the market is going up. So I don't think it was because we were particularly, smart. And since then, obviously, have gone through a lot of up and down cycles. And now, like many people, concentrate my capital into some of the top tier assets to help mitigate that risk. And I think a lot of people do that, right? They don't really, mitigate the risk via hedging. They just, get some stable coins like USDC or USDT, and kind of diversify rather than actually mitigate their losses.
Yeah, I actually do the same. I do not use derivatives or day trading, but I use DeFi protocols, a lot of different types of solutions categories that we are using on our own. And we also have an educational program for DeFi investor that is live right now. And I believe many friends and DeFi investors right now are listening to us. So it would be great to know how do you suggest to hedge their risks? So how do you maybe suggest to rebalance in order to avoid these liquidations and losses?
Yeah, absolutely. I mean, if I can, I can actually show them how to do it on Umoja right now. It'll take like 6 seconds.
Yeah, let's do it. Let's do it.
So here is effectively how you would hedge on Umoja. So let's say we have some ETH that we want to hedge, and let's say we only have $200 worth, right? Not too much, but it's what we got, right? And we want to make sure that, hey, we're kind of scared that ETH is going to go down over the next week or so. So we're going to hedge 2 weeks from now or a week or so from now. And now here's where it gets a little technical, but I think it'll be easy for everyone to understand. Just like when you have an insurance plan and you get in a car accident, and that's when your insurance plan should activate, right? It should cover you. We have a strike price. This is the price that you want your coverage to activate. And so ETH is around $2,800 right now. Let's say we want to do this at $2,600. So we got in at 24. We want to lock in at 26, and anything, at or below 26, we're going to get our money back. And then we'll see, a few details as to the collateral that we have to put down, the fee. So not too costly. It's $30, right? And there you go. We're pretty much hedged. Close this up, and we're good to go. And so effectively, you covered your, $200 in literally like 10 seconds. There's no liquidations at all, so you have no issue with that. And occasionally, if the market gets really volatile, you can top up to make sure you maintain coverage. Or if you see that ETH is going up, you can close your hedge at any time and get your collateral back. And so this is just something that you can't do in normal derivatives markets. And we try to make this experience, as easy as possible for people.
Yeah, love it. Thank you for sharing. It definitely took less than 1 minute.
There you go.
Yeah, that's cool. And what chains are you supporting now, and what chains you plan to support in the future?
Yeah. So right now we're on the Ethereum network. When we launch V1, which will be fully decentralized and leverage multiple perpetual decentralized exchanges in the backend, we'll be on Arbitrum and Avalanche. And the nice thing is that because some of these perpetual dexes have synthetic assets, we actually can hedge assets across chains. So as you might have noticed, we can hedge Bitcoin now, right? And we can support other assets that might not necessarily be directly on ETH or ARB or AVAX.
Yeah, that opens a lot of doors for traders. Great to know. Perfect. I think it would be nice if you can share the presentation regarding Umoja, so we can deep dive into the details of the project together.
Yeah, absolutely.
A product or investor's deck, feel free to share your screen.
Absolutely. And so here we have, and let me know if you can see it. But yeah, I mean, obviously backed by some of the best. So Coinbase Ventures, Blizzard, QuantStamp, Blockchain Founders Fund, Orange DAO, 500 Global, and more. Unfortunately, we couldn't fit everybody on here, but to our investors, we love you. It was not because we're slighting you. And again, the biggest issue here is that so many people lose so much money in crypto, and this is honestly one of the bears, or kind of the demarcations of the crypto brand. When people hear crypto, sometimes they think maybe scammy, or no, you shouldn't put your money in that. And that's always because there isn't a primitive for risk mitigation, right? There's only primitives for generating yield. And as much as we all want to make money, it's very, very important that you cover your losses, that you cover your downside. But traditionally, that's been super difficult. And so, like you saw, we do it in a way that is not only simple, but it's actually more cost efficient than any options protocol or exchange in crypto altogether, right? The issue with derivatives markets and crypto is that they're super volatile. And when you have a very volatile market where things are moving in prices up and down, that means the derivatives markets are going to have very wide spreads, right? They're going to be expensive, and they're not going to be very flexible. And so we found a way to enable you to take advantage of derivatives markets, not have any market knowledge, but manage your risk in a way that's 30 times more affordable in terms of upfront costs, to get these put options, but also very, very flexible, being able to opt out and not have to trade an option to somebody else, and greatly lowering your counterparty risk. And the way that we do that is we actually create synthetic options. So what does that mean? That means that we take one instrument and we trade it in a way that replicates the value of another instrument. In this case, we're taking futures and we're doing algorithmic trading in the background, and it's replicating the value of an option. And by doing this, you get a lot more liquidity, you lower your costs, and you have a lot more flexibility because futures are perpetual, right? They don't have terms like options do. And so this gives you not only the ability to minimize your risk automatically, but we can also allow you to put bets or go long via call options more cost effectively as well. And that's coming soon. And what does this do, right? It enables a whole new asset class. Now you can have hedged assets. So a quick question, for everybody, and just think about it in your mind. Would you rather hold Bitcoin or hedge Bitcoin? The difference is that the first has downside. If Bitcoin goes back down because there's some scandal or the SEC gets really angry, you have to deal with those losses. Hedge Bitcoin, it doesn't have downside. And so just like the yield-bearing tokens that we see, like AETH or AAVE, et cetera, that generate an APY for people, now we can have tokens with embedded strategies to mitigate your risk, and you don't have to do anything. Of course, as I said before, the issues are that everyone is complex and expensive as hell. Pardon my language, but no one likes either of those things. They don't like expensive things. They don't like complexity. And so we're trying to make, accessing the derivatives market and leveraging some of the powers that it brings to finance to anyone who seeks to have it. And of course, for those investors out there, our go-to-market is pretty simple. We're introducing a primitive. We want to get to people to change their behaviors. And so we leverage a large network of influencers, but also PR and certain significant partnerships that we have. And our goal, over the next 2 quarters is 20,000 hedgers to have 50 million in notional hedge. And that's how much money we'll be protecting from losses. And hopefully beyond there, we get even bigger. And of course, in this round, for those that are interested, there's 15% left. We're raising $4 million, and we're seeing actually over 50% month over month growth. That's a lot higher than that now. So anyone who wants to support our partner, we would certainly appreciate it. And of course, I'm just the talking head. Even though I have a lot of experience, I have amazing partners. So Karima and John, ConsenSys alumni. Karima's 10 plus years in digital marketing experience, worked at Valora. Cello has been an interim CEO at a stealth company at A16Z. And John has created products that support over 300 million users, 15 plus years in senior product design experience. And then last but not least, Colin, our head of trading, 15 plus years at FX Quant, RBS, and Credit Suisse background. And then we also have our head of technology, Shishong Zhang from Santander Bank and Ethica. And that's pretty much it. If you're interested, feel free to reach out anytime.
Well, love it. Thank you for introducing that. Great team and a lot of strong investors in your cap table. I'm curious to know what suggestions would you give DeFi investors right now in general to think about their strategies So maybe some practical advice.
So the biggest thing is that I know that we're in a crypto bull run, so people get super geared up, like everything's going up forever. But we know you always have to get yourself out of the emotions, as everyone knows, and tether yourself to the reality that crypto bull runs, they're cycles, right? Things go back down, things self-correcting. Even if you correct above what you started at, you still want to manage your risk. So one interesting strategy, for all the DeFi investors out there is don't think of hedges as, hey, I think everything is going to go down. Think of hedges as, how can I lock in my gains, right? Today, Bitcoin may be at 55,000, 52,000, whichever, right? How do I lock that in, knowing the market's going to self-correct and it's going to go back to 50, and then it may go to 60, right? It's a pogo stick. It goes up and down. And if you do that, you will be much more successful in this bull market than anyone else. You'll capture all the gains going up. And the great thing is now you can do it very simply, and you can do it at a fraction of the cost that you would be able to do it otherwise.
Yeah, thanks. I love this phrase, like locking your profit.
Yeah. It's one that bull market people are much, they like that better. Covering your risk is a little boring.
Yeah, definitely. Thank you. That's very helpful. I enjoyed our conversation today. I would like to encourage our audience to provide the questions so we can see them in comments here in the chat. So guys, don't be shy. Provide the questions regarding different instruments, hedging strategies that you would like to ask Robby. So we have the first one. My question: what's your view on traditional market risk management tools in the DeFi markets, such as VAR, expected shortfall, stress scenario, etc.?
Yeah, so I think that a lot of the traditional market tools, they operate in a TradFi environment in which risks are more easily accessible. And I think that one thing that a lot of, particularly crypto hedge funds, I think is a perfect example of where institutions are, is that there's still an uneasiness as to how to mitigate some of the nuanced risks that you see in DeFi in contrast to TradFi. A perfect example is that although you may not have institutional solvency risk or the risk of a poor performance report from a particular stock in crypto, you do have exploit risk, right? Smart contract risk, and that's very difficult to assess. You also have there's a dissonance between how a project is doing and how the price is doing. So I think Solana is a perfect example. Solana recently had a network outage. You would think from a risk perspective that would cause negative price action, but it doesn't necessarily do that. And in other cases, like the BTC ETF approval, we thought that we were going to get to 50,000 a lot earlier than we actually did, and we didn't. And so I think that the market forces are not as directly correlated in DeFi as we're seeing as they may be in TradFi. And I think that that's continually changing, and why there's some uneasiness going into this bull market, because it's not like previous bull markets where we saw immediate gains right off the bat. It's much more trepidatious. Another thing that I would also say is that as these institutions, particularly the large asset managers, get into the market, we have to take into consideration their motive for getting into the market, right? They're not going to get into the market at a high price. They are going to do things to make prices a bit more favorable, right? We've seen this in the commodities market where they've introduced papered gold, right? And that's why you see, gold's prices being relatively steady in contrast to the actual supply that there is. And so I think that we're starting to see these tools come up. I myself rely a great deal on the Masaris, the blocks, a lot of insights-driven research firms that can give me a way to assess risk more broadly. And then, of course, another thing, of course, to mitigate risk is just to stick to core assets, right? Stick to Bitcoin, stick to ETH, because they've proven not only network validity, but they've also proven value in the context of regulatory ire, right? By being considered digital commodities rather than potential securities as regulation forms.
Mm-hmm. Interesting. Thanks, Robby. Question from me: what features do you use in Messari? What are the most useful for your strategies?
So I'm always looking at the state of So, typically Messari will do a state of different networks and protocols. Usually I try to glean, because it's very, very interesting. I mean, those state of reports provide effectively a high level overview as to why certain protocols and networks are having traction. And that can have, a relative relation to price. I'm also constantly looking at, okay, which ones are indicating any burn models, right? So, for those who are unaware, sometimes networks and protocols, they'll burn tokens on purpose, right? Or they'll lock them up on purpose to create deflation. And interestingly enough, in contrast to that of corporations trying to do that, which is always proven never to create, a positive increase in share value, for protocols, it's actually been quite the opposite. It's usually a market signal that that protocol is doing well. They'll usually either sell those assets off or burn them to diversify their treasuries. And that typically does have positive price action. And so those type of things give you a good understanding as to where things might be going. But of course, I think, and this is where crypto is a lot different from traditional finance, social media is important, right? The marketing associated with a particular project does have undue influence on its price. I think this will change over time. But we're starting to see that TradFi is starting to have, that, nuance as well. I wouldn't say it's an issue, but nuance. The whole GameStop situation was a perfect example of that. Because people have, access to information and can coordinate more generally, now you're going to see price manipulation from the retail side, just like you've seen it historically, institutionally.
Mm-hmm. Yeah, interesting. Thank you. Definitely looking for Messari as well. Just wanted to understand what are your tips. Very helpful. We have two more questions. What makes Umoja a strong contender as a crypto risk mitigator amongst other usual DeFi protocols?
I would say ease of use above everything else. I mean, we do offer, lower pricing in terms of getting into these things, in terms of being able to protect yourself. But at the end of the day, when you engage with any new application, you're trying to figure out what is this? How am I using it, right? And you can, use it very simply. I think that's incredibly important, especially in the context of crypto, because we're not famous for good UX. That's not something that we've been great at historically. And so I would say that first. Beyond that, I think it'll be customizability as well. And so for those who are more into DeFi, you may have liquidity provider positions on Uniswap, for example. So you may be exposed to two assets at the same time. We can provide hedges for that. We can also provide calls for that. And so there's a level of customizability without the counterparty risk associated with options liquidity that we can start to introduce not only as standalone offerings for the people who want to mitigate the risk, but also embedded within other products. So we've been talking to liquid staking protocols to enable zero downside staking or zero loss staking. And these are things where the user doesn't have to understand what is taking place in the background. They can just purchase the asset. And I think that that's the future of DeFi. It's going to be tokenized investment strategies that previously a retail investor could only get if they had Goldman Sachs as their asset manager. Now they can get it within a single asset.
Yeah, thanks. Great. And we have more questions. What feature makes you extremely bullish about your project?
So I would say that there are two. One, we will have Boost. We'll have Boost, which is for calls. So we will enable the same thing that we enable for hedging for calls, because we know a lot of y'all are long, right? And so that definitely gets me excited, because I think people will use that a lot. But the second is just composability, right? Traditionally, protocols, you have to go to that protocol, you have to go to that application to use it. This is an opportunity to be embedded in existing protocols and not have people even go to the Umoja dApp at all. So being able to embed ourselves as that risk mitigation factor within future tokens, right, that are generating yield on Curve or Aave or whichever, but don't have any downside because there's some proportion of that portfolio that has Umoja based assets, is really, really exciting, because it introduced a much safer crypto, a much safer DeFi. And now we don't have the excuse to, take out a second mortgage and, put it on Bitcoin.
Yeah, that's funny. Yeah, we also have a wonderful question. So are there any common mistakes or pitfalls that beginners should be aware when they hedge in crypto?
So for those that do, I would say, not well, I would say thinking of hedging as a way of only thinking that the price is going to go down. It's less of the action, it's more of the mindset, right? So a lot of times when I go into people and say, "Oh, are you hedging your position on Bitcoin or ETH?" They're usually in those communities because they believe in the long term and they've held Bitcoin and ETH for a very, very long time. And I would say hedging a particular asset doesn't mean that you don't believe in it, right? It just means that you're locking in your gains. You're making sure that you're never overexposed to anything, while still holding the asset, right? And I think that, the issue is that that's where greed can set in, especially during bull markets. Because when you see something, I mean, it's not like this is Bitcoin's first time hitting 50K. This is its second time hitting 50K. It's done this before, right? And then we went into a terrible depression. And so I'm sure all of us probably wish when it was at 65, near hitting 70, that we had locked that in, because we probably would have had 7 times more Bitcoin now when it's at 50. And so I think the psychology of hedging your risk is something that people have to revisit, rather than just thinking, "Oh, I'm shorting this because I don't believe in it."
Yeah, love it. So that's why actually we invited you to provide more insights and practical solutions for our community to hedge their investments. So that's really important, and I love your approach, your products. So thank you for sharing, Robby. We have one more question. Can we say Messari reports are more fundamentally driven, while trading risk management tools are more statistically driven?
Yeah, that is a very good question. I would say yes, but I think that the issue with a lot of I think the issue with statistical analysis in crypto is that it lacks sentiment. And sentiment is a huge price driver in crypto. Fundamentals are more loosely correlated than I think people think, right? Again, going back to the Solana network outage versus its price, right? You would think, fundamentally, if it had a network outage, you would think there'd be a depression for Sol, right? But there isn't. But I do think that tokenomic design and the fundamentals of it, for example, like lockup or burns, can have direct effects to price. And so it's really a combination of sentiment, statistical analysis, and fundamentals. And those three, if that was if I had a tool that could just take all three of those things and guide investment strategies, I think it would perform a lot better than most.
Yeah, thanks, Robby. Interesting. And what tools except Messari can you suggest to our community to try?
So other ones that I use, Dune Analytics, for sure. Dune Analytics is more on the fundamental side in terms of what's actually happening behind a protocol or a network. I would also say DeFi Llama. Obviously, DeFi Llama gives you a good high overview as to the performance of all these protocols. And then also there's a treasury one. I believe if you Google DAO Treasury, I'm forgetting the name of it, but if you Google DAO Treasury stats, it's the first thing to come up. It shows you the treasury holdings of all the DAOs, which is also important because, obviously, protocols and networks, they're like little business economic units. They're like little microeconomies. And so understanding how much they have on hand to spur growth within their communities is also important. So those three are what I use as well. Token Terminal as well. Token Terminal is amazing. And then I think Token Unlock. Those two are really good.
Mm-hmm. Understood. Thank you. And also one more practical question for me. What protocols are you using right now in DeFi?
Yeah. So I still use Uniswap a lot. Uniswap's like my gateway. I use GMX a good bit. Still use Yearn. What else? Those are my core. Sometimes I use Maker quite a bit. I'm very inspired by Maker in terms of how decentralized they are, but also they have such a complex system and they execute it so well. So Maker more as a reference point. But those are the ones that I'm mainly on. I'm pretty vanilla right now in terms of risk.
Understood. Thanks, Robby. Very interesting, very helpful. We have the last question from the audience. Deep DAO, is that the right name of the platform?
Deep DAO, yes, Deep DAO, Deep DAO. Adam E, you're right on it. Deep DAO is they have good data.
Sure. Thank you for joining us today. It was extremely useful for us to know more about crypto hedging and about Umoja. I'm really excited and will be personally using this protocol, suggesting it during our next programs so we can practically implement the best strategies from professionals like yourself. So thank you for joining us, Robby.
No, I appreciate you, Ivan, very much, and then 3X Capital team, and hope to talk soon.